Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Karen McCormick, Chief Investment Officer of Beringea and Manager of the ProVen VCTs. Hello, Karen.
Hi, Alex. Good to see you.
First, could you just tell me a little bit about who Beringea are?
Sure. So Beringea is an early-stage growth cap investor with $675 million under management across our offices in the US and UK. We have a 25-year plus track record of investing in early-stage growth cap businesses and about 60 companies in the portfolio.
Okay, so tell me about the ProVen VCTs. What's their aim? How are they going to help investors?
Sure. So the ProVen VCTs invest in early-stage growth cap businesses. For us, that means businesses that have significant growth opportunities and market opportunities, but where we see we can mitigate or minimize our downside risk. We've been doing that for 25 years plus, and that strategy has allowed us to return generally a 5% dividend to the investors year on year, as well as capital appreciation, and on occasion extraordinary dividends when we have great realizations.
Okay, so perhaps you could just tell me a little bit about the type of companies you're looking for and how you find them.
Sure. So early stage growth cap for us means businesses that have commercial traction and revenue. The key things we look for are really the team is the most important, the traction, which for us means revenue, generally at the time we invest, between $1 million and about $30 million in revenue, so decent commercial traction. The market opportunity, could we see this becoming a significant large business, potentially a business that can expand beyond the UK or beyond the home country? And then last but not least importantly is the profitability profile. So for us, at the time that we invest in the business, it either needs to be profitable or we need to believe that it will get to profit off the back of our syndicate of investors. And the rationale for us is we've been through many different economic cycles. We're very happy to keep consistently investing in a business, let them go through the J-curve of losses, and then come back out the other end, back into profitability or break even. But we don't want to be constantly dependent on the market to provide the next round of funding to keep the business alive. So we do continue to reinvest and grow those businesses, but we're looking for profitability profiles that allow the business to become self-sustaining. So those are the kinds of businesses that we invest in.
Okay, so last year, £542 million went into VCTs. This year, it could be $1 billion. Sounds like an awful lot of money. Are you finding it hard to get those deals? Is there too much money chasing particular deals and pushing the prices up?
It's a really good question. Prices are definitely going up, and what we keep seeing is that the prices go up, everyone's speculating about when they're going to come down, but we haven't really seen that happen. Excuse me. We saw the multiples for SaaS businesses fall briefly in the US last year, but they came right back up the next quarter. So we are seeing the multiples getting higher and higher in the market. For us, that means we're having to work harder and harder to make sure that we spend the money responsibly. We're willing to pay reasonable prices for very good companies, but we have to believe that we're going to generate excuse me, a great return on the back end of it. For us, that means we're often looking for either proprietary deals or deals where we can consistently re-up in a portfolio company that we see doing well. I think the market multiples are getting higher, but for us, we're finding opportunities to spend the money. We just have to work very hard for it.
Okay, and do you want to just talk through a few examples of companies you've recently bought?
Sure. So we've invested in, and I'd just clarify that we, as a growth cap investor, we take minority stakes. So we don't do buyouts, we just do growth capital, and generally that means roughly between 20 and 50% ownership in the businesses. A couple of the recent investments we've made, and I'd talk about the sectors that we invest in being generally media and technology, consumer products, business software and services, and healthcare. And a number of our recent investments and exits have followed those sectors. So I'll talk about one that your colleague just mentioned to me, actually a business called Deep Crawl, which helps to crawl websites to identify where there are things like either broken links or they're not optimized for SEO or SEM or PPC purposes. So that's a business-to-business sort of company. And we believe in the future of e-commerce and internet, and we're only going to see more and more demand for services like this. We've also recently invested in a business called Smart Assistant, which is actually not a UK-based business, and we would expect to see more of our investments going to businesses that are not necessarily based in the UK, but they have a very strong presence in the UK. It gives us access to talent across the continent as well as more opportunity. Smart Assistant provides assisted shopping services for online shopping. So if you're looking to buy a refrigerator, it might help guide your shopping and ask things like, what is your budget, what kind of features are most important to you, and help bring you to the right kind of product.
Okay, and you mentioned at the beginning you were a minority investor in most of these, but how much involvement do you have in running of the company? Would you have a seat on the board typically?
We're highly involved investors. We never run the businesses. We invest in management teams we believe can take the business to exit. They aren't necessarily always complete, the teams, but generally we've got a strong CEO, often an FD, often a COO, so there's a core team there that might need to be augmented before exit. Our involvement is a board seat. In effectively all circumstances, I believe we've taken board seats, but we talk to the management on a regular basis outside of the board meetings. So when the business is going through a particular transaction or a particular growth opportunity, we might be speaking to them daily. In other circumstances, it might be every couple of weeks.
Okay, let's just take a look at some of the exits, because that's
Sure.
obviously where returns will come from. Could you tell me about a few of your exits?
Sure. Last year we exited a business called Monica Venator, and that was kind of a very typical example of how we invest, because we came into the business relatively early on. They had a bit over £1 million in revenues. We invested for them to open their first retail shops. Once they had opened the shop and we could see that it was profitable and growing, we then put a significantly higher amount of money into the business. That business was sold last year for 12 times our original investment and 6 times our total blended investment, which was obviously a strong exit for us. We also exited a business called Community Pharmacies, or APM Healthcare, which runs a chain of 24-hour community pharmacies. That was an excellent exit for us. And then more recently, we exited a business called Third Bridge, which is an expert networks business. That was a great exit for the VCTs as well.
Okay, and so those are successes. What about failures?
Yes, it's a good question. Of course, we have failures, and because of the way that we're investing, we're generally looking for businesses with commercial traction, and we generally invest with some kind of downside protection, so either preference shares or loan notes or something like that. For us, that means when things go wrong, it's not necessarily a write-off. It just means rather than getting the 3 to 10 times our money we were hoping, we get our money back, or 1 to 2 times our money. So that does sometimes happen, and usually that happens because either we misgauge the market opportunity or size, or we didn't quite get the management team right.
Okay, and of course the rules have become stricter. So has that meant you've had to invest in riskier, younger businesses than previously? And would you expect the sort of risk profile to change in terms of would you expect more failures in the future?
I wouldn't expect a drastic change in our risk profile. I mean, we've always invested in early stage growth cap companies. The VCT rules are structured around being able to invest in those sort of businesses. And they are, I mean, the businesses that we invest in today and have invested in, they are relatively young, relatively risky, relatively early stage businesses where we try to find commercial traction and protect our downside. The rule changes for us have not had a particularly significant impact on our strategy. There is one rule in particular in which says the company has to be no more than 7 years old since its first commercial sale. That has applied to a couple of the businesses that we've looked at, and there have been a handful of businesses in the last 2 years that we couldn't invest in because they were more than 7 years old. Outside of that, we haven't seen a dramatic change in the strategy for the VCTs.
Okay, so one final question.
Sure.
If I'm going to invest in a VCT this year, why should I invest with ProVen?
It's a good question. So we have a very strong track record. We've delivered consistently great returns for our investors, and we can see them re-upping in us every year. We're grateful for that. You'd be buying into an existing portfolio of very strong performers with quite a few companies that are ripe for sale. And I think a point of differentiation for us is our US office, which allows us to not just benchmark the businesses in the portfolio, but help provide on-the-ground expertise for US expansion. And we've leveraged that asset multiple times in growing the portfolio companies and then helping to exit.
Karen McCormick of Beringea, thank you very much.
Thank you.